Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site is Maddie Radner, Director on the Nasdaq Market Intelligence Desk, Bob Lang, Chief Options Strategist at ExplosiveOptions.net, and Joe Boyle, Fixed Income Investment Specialist at Hartford Funds. We're here to discuss how the recent Fed rate cut and forward-looking policy impacts different segments of the market. It is great to have all of you with us. Welcome to Trade Talks. Joe, let's get the obvious question out of the way. Thoughts on the Fed? Too big, too little, not enough?
No, it seemed like 50 basis points was the right amount after you heard Powell explain himself in his press conference. There was debate walking into the meeting. Would we get 25? Would we get 50? That's not normally the norm. We're pretty sure, confident about what we're going to get. But the 50 came out. The market absorbed it fairly well. I mean, it was very positive for equity so far. Rates are actually higher today, post-FOMC, which is counterintuitive what people would expect. But given his concerns and the sentiment of the committee about how they've become more concerned about the employment picture and less concerned about inflation, 50 basis points, seemed like the right move for the Fed to make at this point.
Bob, do you think it takes some of the pressure off of a rate move the day after the election?
Absolutely, and if you notice in the volatility curve, the term structure has a little bit of a kink in the curve if you look out for October, November, which is kind of playing into the fact that a lot of market strategists are expecting a lot of chaos after the election, and once that wears off, you see volatility starting to normalize out into 2025. In fact, out to May, we have a much more normalized curve. So basically, I think as far as the volatility is concerned, once we come back down after the election, I think maybe the middle part of November, I think things are going to normalize. This happened back in 2020 and 2016 as well too. Right. And then a lot of panic was starting to settle in, and all of a sudden all that panic went away, and what ends up happening is volatility comes down, and the reverse trade is that equity futures go up. So that's my thinking, is that I think the equity future market is going to, I think we're going to hit 6,000 on the S&P 500 by the end of the year, maybe a little bit more than that, and then we'll reassess in January.
Well, Maddie, your small caps finally got the rate cut. How are they responding in kind?
Yeah, so now that we're seeing rate cuts, the question is now, how will that shape equities? And we think tech will continue, large cap tech will continue to be attractive, but we think there'll be a rotation finally into small caps, into value stocks, and we're already seeing it play out a little bit. The Russell 2000 actually saw its strongest streak since March 2021 last week. We're also seeing value style ETFs really see their biggest inflows again since March 2021. So we're already seeing that kind of appetite come back there.
Right, but that's what everyone's been looking for, broadening of the market, so you don't have that risk concentration in a handful of stocks or one specific subsector. Joe, the question to you is, what about fixed income? Is it still attractive, or did investors miss the boat here?
No, I don't think anyone missed anything. As I stated, rates are actually higher than they were before the rate cut. Two-year rates have come down pretty significantly since the beginning of the year, but 5, 10s, and 30s are actually not too far off their levels of where we started the year. So there's still a lot of attractive carry out on the curve, and there's a significant amount of issuance. 2024 is likely to be the second highest year for investment grade issuance since the pandemic, since 2020. A lot of that, and even 2023 issuance, is coming in at 5, 6% coupons north of that, and these are default remote companies. So it's extremely attractive in the fixed income market right now. I don't think anyone missed anything with the rate cut. I think rates still stay supported here, even if we go another 50 or maybe another 100 over time, but fixed income still looks good.
Right. I mean, realistically, well, let's hope that we don't get back to those levels that we saw. That was an anomaly. It was during the pandemic. I mean, if it were to get back to those levels, that suggests that there's something pretty wrong with the economy. So I don't think we should get back to those rates anyway.
You hope not. You don't want the big risk-off event. You don't know what the unknown is out there, but the economy does feel like we're in a good spot. I mean, we cut rates, but stocks are at their all-times high. We're talking about this being positive for stocks. We have 4% unemployment. People still feel relatively good about the economy. The Fed made the cut because they saw a couple things, the pace of the deterioration of jobs, revisions, the idea that maybe they're skating to where the puck is going. But they themselves weren't too dour on the economy.
Yeah.
So
I mean, I think really what the key is here, and we know the consumer, it's been really hard to bet against the consumer, right?
Sure is.
And so jobs to me is a little bit concerning, so I'm hoping.
Well, I would say by and large, over the past 2 years, just strong job growth has really been the linchpin for the strength of the economy. And if you look back over the past couple of years, there was worry that we were going to be heading into recession. We have not even been close to coming into recession. I mean, 2.5%, 3% is not lights out, but certainly if you go back to December quarter of 2023, 4+% growth, and we haven't slowed down since then for the past two quarters. And we're coming up to the end of Q3 here next week, and I think that's going to print another good quarter. I want to say Atlanta Fed GDP now is predicting a 3% growth in this quarter. And leading into the holiday season, as Joe mentioned, jobs are plentiful. People are feeling pretty good about the economy. And fourth quarter is always pretty strong. And again, it's going to be going up against heavy comps from 2023. So I think if we still come into that 2.5%, 3.5% growth rate, it's nothing wrong with the economy. And I think.
Well, by the way, there's $5-6 trillion on the sidelines as well. I mean, that
a lot of money,
can
a lot
help.
of cash.
If you want to think about the Tina trade for a moment here.
That's right.
So, well, has there been any impact on cash, right?
So cash is interesting. This is the $6 trillion we hear about every day on the sidelines. Cash is going to be an allocation. Even with 100 basis points cut or 50 basis points cut, 3 to 4% in a cash bucket is pretty comfortable for people.
Right.
What I try to posit for people is there's really 3 scenarios on why I think I would want to be in bonds. The first one is if you think rates are going meaningfully higher from here, I actually can't talk you out of your cash allocation. You should
Right.
stay in cash. If you think we tread water, which to me is the ideal situation, where rates kind of stay where they are, obviously 2s have come down, but 10s have held in there, bonds are going to outperform cash. High quality bonds are going to outperform cash. But if there's some sort of risk-off event where we see a steep decline in rates or we see even a gradual decline in rates, high quality bonds are going to really outperform cash. So in 2 out of 3 scenarios, it favors bonds out of cash. And I think the third scenario is remote in most people's minds. I don't think people think rates are going meaningfully higher from here.
Yeah.
So I think that should be an impetus for people to get out of cash. It just, they like the safety of the 3%.
So Maddie, if we take a look at the IPO market for some indications in terms of Q4, clearly
Yes.
the election is that's going to be a big inflection point, right? Depending on how that goes.
The IPO market is definitely gradually reopening. We've seen 158 total IPOs across the U.S. exchanges, raised just under $30 billion in proceeds. Last year we saw 153 IPOs that raised only about $23 billion in proceeds. What we're noticing now is the appetite for different sectors are moving forward with their IPO plans, such as biotech, such as some community banks. But like you mentioned, the election will have an impact on some sectors as well as IPO timing. So historically, companies either try to move forward in October or December, especially within the healthcare sector. They might be waiting on the sidelines until certain policies get figured out and some of the election noise settles a little bit.
Right. I mean, and it could potentially be a Q1 thing as well. I mean, it's sad to say, but it also depends on the transfer of power and when we can start to have some insight into what policies could be framed.
That's exactly right. And what I find interesting, what Maddie said about the IPO market too, Jill, is that there's some very exciting companies waiting to come to the market. I mean, names like Klarna, names like Stripe, and some of these other high-tech names, and even several I saw that are in the AI realm as well too. So, once that market opens up, it opens up a lot of opportunities for investors upcoming. And I think Morgan Stanley put out a report saying that they expect over a double-digit growth in IPOs over the next 3 years into 2027. So I think the prospects are looking real good for that.
Good. We'll be busy here at MarketSite. So Bob, when you think about, and of course, if you're a day swing, longer term trader, you're always thinking about your time frames. What are your recommendations if you are a longer term investor? I mean, is it really any reason to move things around, or do you just ride this out like any other volatility event?
Well, I like to synthesize what Joe is doing and also what Maddie is doing. Joe with fixed income and small caps. I like an environment when rates are low. So I'm looking at names like in retail like Home Depot, names like Lowe's, and then also going into the home builder area. I think home building is going to continue to be strong, especially when rates are low. You're going to get some new buyers coming in there. I know housing prices have gone up quite a bit over the past couple of years, but I think they're going to settle down a little bit, and I think there's some opportunities right there. I also think that defense areas are going to be strong. Defense names like a Lockheed Martin. I mean, I don't mean defensive names. Defense names like a Lockheed
defense
Martin.
sector.
Right, correct. Yeah. Defense sector. Northrop Grumman is going to be good. I think Raytheon has been a strong name. So those areas over there outside of tech, and I think tech is going to hold its own. It's still in a low interest rate environment. I think it's still going to be very strong. But I think outside of the tech area, those names are going to do very well over the next 12 to 18 months.
Oh, good. Stock picking environment again.
Absolutely.
Looking forward to that. What about credit, Joe?
Yeah, I mean, credit's interesting because most people look at credit and credit spreads and they say, well, credit, it's historically tight. But you have to think about it from a total return perspective. There's still plenty of bonds out there, sub-investment grade, investment grade, that are trading at a discount because they took a bit of a beating when rates backed up in 2022. So they're still subpar. So while the credit spreads are tight, you still have a lot of capital appreciation ability there just due to the passage of time or if rates come lower. So if we are talking about the soft landing or just a good economy overall, credit spreads can be tight and stay tight. We've seen that over history. So credit can still be supported. Now, everything depends on your risk tolerance, your ability, your willingness. So, investment grade makes a lot of sense, but there's a lot of value in the high yield space too. But again,
Well, sometimes you're high yield for a reason.
correct.
Right.
Right. But the spread itself shouldn't scare them away. You should really be looking at the total return possibilities. And you talk about stock picking, bond picking too. You're high yield for a reason. You got to avoid the landmines.
Are there certain areas within the fixed income space that you prefer, whether it's emerging market or domestic?
For the risk reward, I do think it's the investment grade space.
Right.
I just think 5-6%, you're not stretching for yield, you're not reaching down the credit stack. You're getting a reasonable amount of return for the risk you're taking. And there's a whole swath of investors out there who didn't have that ability for 15 years to get 5-6% and feel comfortable about it. So that, to me, is the risk reward is there.
All right. And Bob, just to wrap up here, anything from an options perspective in terms of hedging portfolios, or perhaps, it wasn't a good thing being long this year?
Well, certainly not. And with double-digit growth in the SP 500 and now the Nasdaq and now the Dow has joined into double-digit growth this year. Pretty unprecedented when you come off the strong year that we had in 2023, but it's there. I still think it's important to keep some protection. We're going to have some bumps in the road. I mean, we had, if you remember the early part of August, we had that yen carry trade disaster that happened with the markets. The markets are down 4-5% just in one day. You got to have some protection, and even earlier in the year, in April, when the realignment happened between the markets and the Federal Reserve with the expectations of Fed funds rate. So, the market swooned back then. So I think you gotta have some protection, gotta have some puts, but I think you can slowly get aggressive and start buying some calls or buying some stocks. Writing calls against it, it's always a great strategy as well too.
All right, we'll leave it on a positive note. Appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.